All right, let's go ahead and get started. Ladies and gentlemen, just wanted to say thanks so much for joining us for our first market update of 2025. Markets have been a little choppy here at the beginning of the year, but as you know, for the past 43 years, it has been our mission to deliver clarity and confidence to help secure your financial future. And that's what Nick will be bringing us today. A replay is going to be posted on YouTube. So if you're not subscribed there already, be sure to go ahead and do that. You can subscribe to our Spotify and Apple podcast as well. So it helps us get the clarity and the confidence out to more and more people. So we appreciate your help with that. And then two reminders before we get started here. Coming up very quickly is our Houston Wealth Insights Forum, which will be April 25th and 26th. We're almost at capacity. So if you haven't signed up for that already, be sure to do that. Whether you are a client or somebody interested in working with us, we would love to have you come meet the team. Again, that's going to be April 25th and 26th, downtown Houston at the Four Seasons. And then start marking your calendars. October 9th and 10th is going to be our annual Investor Day. And we've moved it up a month. Hopefully going to catch some nice late Chicago fall weather for any of our guests who aren't used to it, and have a great speaker lineup already, set to go. We'll be announcing that very shortly. And again, that's October 9th and 10th. We would love to have you join us. Last thing for me before I turn it over to Nick is there's a button down at the bottom. If you have any questions, just go ahead and type them there during the presentation, and then we will be answering those at the end. So we really appreciate you joining us. And Nick, all you.
All right. Thanks, Sam. Thank you, everyone, for jumping on the call today. And you'll notice that I am not in my office right now and not wearing a tie. So where am I? I'm in Florida. We're hanging out with my parents here for a little bit and enjoying some sunshine. But we thought it was very important to interrupt the family vacation and bring you the clarity and confidence. And so we are really dedicated to doing that. And these are the times when we all need it. And everything is all fun and games when the market is going up in a straight line to the right with no corrections and no pullbacks. And then it gets a little bit more scary when we get to the parts in the market like this. And so what I want to do today is instill you with some data, give you some data points that you can hold on to, some math, some statistics, some reasoning, not backed in politics, not backed in narrative or just emotion, but backed by real numbers. And so that's what we want to do today, is to deliver you the good news and really why I think the market is going to be just fine. We're going to get past this volatility, and it's going to take a little time, and it might be a little bit painful. You saw that email I sent out the other week. Corrections are no fun. And they're not. Corrections are not fun at all. They're painful. And by the way, if you have $100,000 and you correct 10%, that's a lot different than having $10 million and correcting 10%. And it just feels worse. And so the big mistake that everybody makes during these corrections is they don't zoom out. We like to say, when in doubt, zoom out. Well, everybody gets wrapped up in the day to day. We call it getting lost in the sauce, and you forget about how far you've come. You forget about how much your portfolio has gone up over the past 4 or 5 or 10 or 15 years. And all we do is we compare our record all-time high statement value. We say, I know what my record all-time high was, and then everything else gets compared to that. Well, that's not really what we want to do. We want to look at a long time of history, and when you do that, I think it'll give you perspective on where you've been and possibly where we're going. So when I think about what people are really worried about today, and some of the concerns I've heard, really this whole presentation today is designed around what we've heard from you, our clients, and some of your concerns. And so one of the big ones that I keep hearing is, Nick, there has to be a correction because everything's just gone up so much. And at some point, what goes up must come down. It's got to be like gravity, right? If something goes up, it's got to come back down to earth. And what I want to do is, first of all, say I disagree with that reasoning and tell you why. And it all goes back to this chart, M2 money supply. And so if you're looking at the slides in front of you, hopefully you can see this. We can send these to you after if you'd like, but what you're looking at is M2 money supply. M2 is all the money that's floating around in our bank accounts, money market funds, cash in your wallet, all the different money that's floating around in the economy. And if you look at a long track record of M2 money supply, it's gone up to the tune of about 2 to 3% per year. And if you know Milton Friedman had the famous statement, and he said, inflation is always and everywhere a monetary phenomenon. And what's he trying to say with that statement? Well, he's basically trying to say that inflation is caused by the government printing money. It's caused by the Federal Reserve increasing the money supply. And so if you've taken a basic Econ 101 course and you've gone through all of that, you remember your professor might have said, why, does anybody, can somebody raise their hand and explain why inflation or why the Fed funds rate is 2% a year? Well, when I was in my econ class, at my first week of school, nobody's hand went up. Mine is the only one that goes up in a room full of about 300 people. And I said, I think they just make it up. Yeah, that was my response. And the professor kind of laughed a little bit and he said, well, yeah, that's basically what it is. And that's essentially true. The money supply goes up by 2 to 3% per year. The federal funds rate goes up 2 or 3% per year. The Fed inflation target goes up 2 to 3% per year. Why? Well, it's kind of just made up. When you have the government controlling the money supply, M2 money, which they do now through the help of the Federal Reserve, they can basically print whatever they want. So we were chugging along at 2 to 3% per year for about 150 years. Well, all of a sudden during COVID, what did we do? Well, we printed a boatload of money. And the exact amount of that boatload is about 38 to 40% new dollars that were added to M2 money supply. And so one of the things you saw happen, if you listen to Milton Friedman, is you saw inflation start to shoot way up. The Fed during 2020 and 21, the reason they were so late on raising interest rates is because they didn't listen to Milton Friedman. They believed that it was all supply chain related. They thought that once supply chains normalized, that inflation would go back to the usual 2 or 3%. Well, we were following other people who said, no, 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 that's not true. In fact, inflation is going to be much more ingrained. It's not going to be transitory. It's going to be ingrained in the economy because, like Milton Friedman taught us, inflation is simply too many dollars chasing too few goods. Now, COVID certainly accelerated the other side, the supply side of the equation. So while we had too many dollars in the economy, that's certainly true, 38 to 40% more dollars printed into the economy. That's that big spike up you see on the blue line there. We also had shortage in supply chain. So now we're starting to have some normalization in the supply chain. Things are coming back to normal. There's some issues like eggs. You're seeing your egg prices completely out of whack. That's not going anywhere. That's going to be around for a long time. The egg prices will be where they're at, and possibly some other dairy costs. But the reality is a lot of the supply chain issues are normalizing. That's true. So you're seeing inflation still stay persistent, but it's not going up at the 7, 8, 9% rates like it was. So what's happened? Well, if you believe Milton Friedman and you believe that inflation eventually tracks monetary supply and it tracks the amount of dollars in the economy, well, you have to believe that inflation is eventually going to go up about 35 to 40% and take a big brunt of that M2 money supply increase. And that's exactly what's happened. We've seen inflation go up about 40%. Well, at the same time in the economy, think about what the Fed essentially did. And I'm looking at everybody on the call today, and I'm basically saying, all right, let's just say there's 100 of us, and out of 100 of us, we all got $100,000 at the beginning of COVID. At the end of COVID, we all were given 40% more dollars. So now we all have 140,000. Well, if you do that across the board, well, guess what? Nobody really has $140,000, do we? No, we're all basically back to break even. So if you've watched home prices the past 5 years, if you watch car prices the past 5 years, if you watch the price of equities, the stock market the past 5 years, what have they all done? They've gone up 35, 40, some cases 45%. And that's the reality of money printing. Asset prices will rise to the tune of M2 money supply. And so, yeah, you're home, you're saying, hey, Nick, I've got all this equity in my house. It went up 40% the past 5 years. Well, good luck, because the next house you go to, you're paying 40% more for it. You're back to square one. It's a wash. And so that's the reality of why I think stock prices have gone up, in part because M2 has gone up. But because of that, until we see a major decline in M2 money supply, if the Fed decides to pull money and liquidity out of the system, I do not think asset prices are going to go down precipitously. And I do not think we're going to fall into a major recession. And we started to see this little pullback. You saw this in 2022. We had a mini recession in the summer of 2022. You see that M2 blue line start to dip off the other side. Well, that was a little bit scary, because if we had started to go back down the other side of M2, we could have had a major recession. Well, we avoided it. We avoided a major recession. We had a mild recession. And you can see now the Fed is back to printing that money, 2 to 3% per year. And I think that will continue over the long run. We don't have to like it, but the reality for investors, for asset prices, is I don't think the bottom is going to fall out of the market anytime soon. That doesn't mean, though, that we're not going to have corrections. In the short term, here's the S&P 500 as of yesterday. I think today it's just slightly lower at 5850 last time I looked. If you look at the past 12 months in the S&P 500, we've had a bunch of these 5 or 6% corrections. And so people's memories are very short term. But we had one of these from the end of December to the beginning of January this year. We had a 8% correction last summer that everybody forgot about. We had a 5 or 6% correction last April. So if you have some perspective, you're going to see that these corrections are just part of life. If you're going to be in equities, you got to just deal with the fact that stocks are volatile. And if we really zoom out, if we go back 5 years now, we go back all the way to COVID, you see that big drop off in the S&P. We dropped about 40% in a few weeks. We came roaring back. We posted a double-digit 20% equity return for 2020, despite having an economic recession, despite having a pullback. We finished the year positive, and then we did it again in 2022. In 2022, the Fed starts really hiking rates. People start believing, okay, inflation really is transitory. Fed's going to stay higher for longer. And we told you that was going to happen. That's why we took the bond duration in the portfolio down to 30 days, because we didn't want to lose money for your safe part of your portfolio. And sure enough, in 2022, the stock market priced in a recession. Stock market was down 22% in the summer of 2022. Well, you live past all of that. You went past all these big corrections, all these big pullbacks, and here you are today, and you're still at record all-time highs. And I don't mean this as a personal attack on anybody, but I just want to tell you, one of the things I saw this morning on CNBC had me laughing. And it was essentially the person who runs the teachers union starting to do an investigation now into Elon Musk and Tesla. And I'm not saying you have to love Elon Musk. I'm not saying you have to like his personality or anything like that. But basically this head of the union was criticizing Elon Musk for Tesla's stock price dropping from its all-time high. It's down about 30% from its all-time high. Well, I just want to say, well, if you do this, if you zoom out the past 5 years and forget the past 3 months with Tesla stock and look at the past 5 years, the stock's up 552% the past 5 years, which all of those teachers have benefited from that lift in Elon Musk and Tesla stock price rise. So this is the common thing that we do as human beings. We tend to zero in on a little tiny event, a small pullback, and then we forget about where we've been. We forget about the long-term trajectory of the stock market. And so again, that's just a small example, but this is what people tend to do. We tend to get focused on what's happening right now, and we forget to look at the big picture. And if you had been in Microsoft the past 5 years, if you've been in NVIDIA the past 5 years, if you've been in Tesla or Amazon or Procter & Gamble or even ExxonMobil or any number of these companies, you'd look at the performance the last 5 years and you'd be happy as a clam. You'd be so happy you just stayed on your plan and stayed invested. So That's what the stock market does, is it climbs this wall of worry. And yes, there are things to be worried about. Yes, there's things to be panicking about, but I would submit to you today, there's always been things to panic about. There's always things to worry about. And by the way, there's never not going to be things to worry about. So even if you're right now and you get out of the market and you're like, Nick, I just can't take it anymore. These 10 or 15 news stories are just driving me bonkers. I got to get out. I hate Elon Musk. I hate the big orange man in the White House. Whatever your reason is for panicking. Okay, I guarantee you in 3 years or 4 years, there's going to be another set of 30 things that you're going to hate or not like or want to panic off your plan about. And so let me give you the big five that everybody's thinking about today. Number one, Nick, the US debt is out of control. It's unsustainable. That is true. US debt is at an all-time record high, but there's two sides of a balance sheet. What's the other side of the debt? The assets. US assets are at all-time record highs. And so if you compare US debt to asset ratios, we are actually under levered compared to history. In fact, we haven't had this little leverage, especially with household balance sheets, since 1985. And so you have to look at the debt in context of the assets. Number two, trade and tariffs are going to cause a recession. This is a common one. Yes, it's true. In history, in the Depression era, we had the Smoot-Hawley tariffs and trade war that did cause a global recession. But you also have to remember it wasn't just those tariffs at the time. It was a mixture of factors. It was the Fed hiking rates way faster and higher than they are today. It was excessive regulation, excessive taxation. This top marginal tax rate was 70 to 80% back then. Then the tariffs just added fuel to the flames. So I don't think this time around is going to be like that. In fact, I would go back to Trump 1.0 in office and tell you, I think this is a negotiating tactic, and it's not really about the trade. It's not really about the tariffs. If you get under the surface with it, I think it's about oil. I think it's about energy. And that's certainly what this seems to be. Guess who has the most energy on earth? Right here under your feet in the United States. We've got more potential for oil production than any other place, and even more than Saudi Arabia. And so if we are able to export that like we were for the past couple years and continue to increase our exports, that's what's going to drive global trade. That's what's going to drive these tariffs lower over the long term. So I call this a trade skirmish, not a trade war. Don't have a panic attack. Russia and Ukraine, then there's Israel and Palestine. There's all these geopolitical conflicts. Could that cause a problem? No. And while we don't like war, we don't want people to go to have these conflicts. Of course, we don't like this. It's not going to, in my opinion, have a meaningful impact on your portfolio. And you're going to see more of this. This is the world we live in. And unfortunately, this is just part of life, but this is not going to be a reason to panic off your long-term plan. Number four, stocks are extremely overpriced. You've heard this before, just like 1999. Well, I'm going to show you in a few slides today that the stock market is actually trading at 18 to 19 times forward earnings. Well, in 1999, the S&P 500 was trading at 45 times earnings. It was twice as pricey as it is today. In fact, if you look at the forward earnings projection on the S&P, it's about the same as it was 5 years ago. Nothing radically overvalued from my perspective. Number five, inflation is going to remain much higher for much longer. This is the one I do agree with. I do think it's going to remain much higher for much longer. And so while I'm bullish on US equities, I am bearish on long-term bonds. And I've been very clear on this. Be very careful what the makeup of your portfolio looks like in this environment. Because while I think US equity returns are going to do well, I think long-term bonds are going to continue to suffer. So here's a couple guiding principles, and this is what you have to have as you go through these ups and downs, as you go through the doom and gloom. A couple key points to keep you grounded. Number one, stocks are a claim on real assets. It's so easy to get lost in the noise of CNBC or Fox Business and see these tickers flying across the screen and see, hear the host talking about the S&P 500 going up or down 500 points and see Jim Cramer with his sleeves rolled up at the end of the closing bell every day screaming about some company. And it's so easy to get wrapped up in that. The reality is it's not just the market. It's not just stocks are a fugazi, woozy, wazi. What are stocks? Stocks are real companies and they're made up of people. Companies are made up of people who go to work every day to work the problem and come up with solutions and new technology. And so because of that, companies, after a while, if they're successful, they grow their earnings, they grow their profits, they save up for a rainy day, they have these massive war chests of cash on the sidelines. And if they have so much cash and they don't know what to do with it, oh, well, that's a great problem to have because they turn around and they start paying you dividends and they do corporate buybacks and they have these fortress balance sheets. That's how JP Morgan is now described. It has a fortress balance sheet. So if we go through another '08 and '09, or when we have a recession or a bigger correction, they're going to be okay. They're going to make it out the other side alive. So stocks are a claim on real assets. When you have a piece of JP Morgan or a piece of Apple or a piece of Microsoft, what do you really own? You own a claim, you have a claim on that company's intellectual property and their goodwill and their assets. And so stocks are a claim on real assets. Why is the stock market up 40, 50, 60% the past 5 years when M2 money supply is up 40, maybe even 50% in some metrics? Well, because asset prices go up with the printing of money. So stocks are a claim on real assets. That's the only place you'd want to be the past 5 years. What happens with these companies? Well, companies have the propensity over time to beat inflation. Why? Because they raise their prices. So you've noticed you've gone through the McDonald's drive-through and you about fell out of your seat because you're like, how did we just spend $40 at McDonald's? Or you go to Costco and you walked in there like I did for blueberries and somehow you walk out $400 or $500 later going, what happened in there? Okay. Well, what do companies do? How come companies can make it through 45% inflation? Because they just raise their prices. That's why assets go up over the long run because they have the propensity to beat inflation. And I would argue companies are in a unique position to beat inflation, unlike any other asset class, because they respond in real time. A bond cannot respond in real time. And so when inflation goes way up and then the Fed has to raise interest rates to deal with that, what happens to those long-term bonds? They get crushed. Same thing with real estate investors. And so now you're starting to see that stocks are the best place to be. And what do those stocks do? Well, they beat every other asset class on earth, including gold. Yes, I know you're thinking about building a bunker in your backyard and stocking it with some canned food and gold bars and maybe some meals ready to eat or whatever else you'd like to do. And I'm going to just say, hit pause on that. I sympathize with you. I understand what you're worried about. But before you do that, the best place to beat all these different problems we have, including inflation, including gold, including silver coins like you see advertised on TV. I get my gold. I won't say the name of it, but you know what I'm talking about. These places that want to sell you silver coins. The better thing to do was just stay in your Microsoft stock, stay in your Procter and Gamble stock, stay in Home Depot. Why would you panic and go buy a silver coin, which by the way are not free? They're charging you 3 to 5% annual fees to hold those things. So, oh yeah, gold is this great asset class. Well, once you back out all the fees that it takes to hold gold bars, you're going to find out stocks were the best place to be. By the way, something that nobody talks about. Are you really going to take your silver coins or your gold bar to Costco and buy blueberries? I don't think so. It's not going to happen. You're going to have US dollars. So that's where you want to be. Number 4, in the short run, markets are a voting machine. This is Benjamin Graham, Warren Buffett's mentor. In the short run, markets are a voting machine, but in the long run, they're a weighing machine. So in the short run, we're trading the market up or down a few percentage points. Why? Because we're trying to figure out what stocks are worth. That's what traders and timers and market makers do. That's a very valuable mechanism. And so if you're going to have the best functioning markets on earth like we have in the United States, you're going to have a bunch of really good traders and market makers. But in the long run, stocks do what? They're a weighing machine. And what are they weighing? They're weighing the merits of a company. Is this company growing profits? Is it becoming more profitable? Is it growing those profits over time? Is it growing its revenues? How is it performing compared to the other competitors in its sector? And so that's why you have to be in equities, because over the long run, yes, we're going to have corrections and recessions and pullbacks. But if you're in the best companies, you will make it out the other side alive. And number 5, this is the most important. If you're going to own these equities, which are the best asset class on earth, they beat inflation like no other asset class. If you're going to be in them, what's the price you have to pay? Well, you've got to be able to have some volatility. You have to stomach the ups and downs of the market. And so if you can remember this, if you can have this as your guidelines through the corrections, through the recessions, you will be okay. And I mentioned Proverbs the other week in my email, and I said, write these words on the tablet of your heart. Remember them. Try to write them down because it's easy to forget that things will get better in the future. So just another note here on stocks or a claim on real assets. If you're in the S&P 500, which many of our clients, almost all of our clients are, and if you're in our stock portfolios where we have the best 50 companies, all these companies for the most part are in the portfolio. Well, what do you really own? You've got a piece of Apple, you've got Nvidia, you've got Microsoft, you've got Amazon, you've got Google, Meta, Broadcom, Berkshire, Tesla, JP Morgan. I mean, these are just the most phenomenal companies on earth. Apple now, I just looked it up yesterday, is sitting on $140 billion of cash. How about Nvidia? Nvidia has grown earnings 1,000% the past 5 years. Why is the stock up 1,000%? Because their earnings are up. This is not Cisco in 1999. How about Microsoft? Microsoft, you literally wouldn't be able to do your job nowadays. Your company would not be in business without Microsoft. Amazon.com. Have you ever watched one of those videos of the Amazon robots in the warehouses? If you haven't, I would encourage you go watch one after this show. Just go on YouTube and type in Amazon warehouse robots. It's incredible. I mean, you'd never sell your Amazon stock after watching this. So we won't go through all of these, but my point to you is these are real companies. And if you're going to be in the market, you've got some phenomenal holdings that make up your portfolio. So where do I see markets going in the short term? And then I'll tell you my long-term view. And then if we've got a couple minutes, we'll do some Q&A. But I basically weighed out a few different scenarios and put some probabilities of what I think could happen in the U.S. economy and the U.S. stock market in the short term. So if we hit recession, I think earnings drop, but multiples will go up. That's usually what we see. And I see the S&P trading sub 5,000 points. Remember, it's about 5850 today. So we trade basically at 4950 in a U.S. recession. I give that a probability of 15%. It's not a 0% chance, but I think it is a very small chance. Then I think our more likely scenarios, we avoid recession in the short term. I think we're going to do well. We're going to start to get earnings reports in the next couple months here. And we're starting to get reports from Q4. Then we'll get reports from Q1 this year. So I put avoidance of recession at a 60% probability where we trade the S&P at 6,300. And that's a pretty good trading range for the first couple quarters of the year. Then I say in a more bullish scenario, we get 15% earnings growth through now and to the end of 2026, which is, I actually think, a very high long-term likelihood. In the short term, it's a lower probability. So I put it at 25% odds. And when you add this up, I think the estimated fair value of the S&P today is about 6,200 points. And so if you're coming in here sub 6,000, if you're buying at 5,850 or 5,900 or 5,800, you've got about 6 to 7.5% upside when you factor in the dividend. That's pretty darn good. So I would tell you when you look at the risk return of the market here, I think the stock market is a buying opportunity for long-term investors. Markets are just math. So how do we come up with some of these numbers long term? Well, we just take the earnings. What are companies going to do in profits? What are they going to make in earnings? And we multiply it by what are those earnings worth in the future? So we say earnings times price, or said a different way, the PE ratio of a stock. And then that's how you multiply those two numbers together. That's how you come up with what we think the market's worth. If you look at all the best analysts on Wall Street now, they say for 2026, because we're not going to care about 2025 profits anymore, we're going to care about next year's. That's how the market always works. It's always a discounting mechanism of next year. We're going to say that the S&P, according to Wall Street estimates, does $320 per share in earnings. At a 21 P, which is, I think, a fair P to put on the S&P. We're at 67.20 on the S&P 500 by the end of 2025, early 26. And if you believe Dr. Ed Yardeni, who came out to Investor Day last year, he's actually even a little bit more bullish than us. He says 7,000 points. So what happens in the short term? What happens as we trade the S&P throughout the year? Well, we're going to hover between $275 in profit, which is where we're at today, towards that estimate of 320. And then we're going to also have a trading range on the multiple we put on on those earnings. So it's not always that the market's valued at 21 times. In fact, right now we're valued at about 18 times forward. So we're going to hover between 275 and $320 in profit, and then a multiple of 19 to 23 times earnings. And I believe you're going to see the S&P trade in this range of 52.25 to 73.60. And again, this is not individual investment advice. So don't go do any trading off of this. Don't make any decisions off of this. But I'm telling you, based on the math of the market and where we see things going and what the crystal ball told us, I think Sam's got the crystal ball with him in the office there. I think the S&P 500 will trade in this range. And so if you can buy stocks today while they're on sale, I think when the next 12 months goes by, the next 18 months, I think you're going to look back and you're going to be really happy you just stayed on your plan. So I'll give you one last quote and then we'll do some Q&A, Sam, if you want to jump in a second. But I just think about the Toto song, Hold the Line, and that's what you have to do here. Just hold the line. And how do you hold the line during these corrections? Well, you just got to turn off your computer, turn off CNBC or Fox Business, and go for a walk or make a snow angel or whatever it is that you like to do. Because once it's all said and done, if you were to just go to sleep today, wake up in 12 months or 18 months from now, I think you're going to wake up to the S&P being higher than it is today. So this is the famous Shelby Davis quote: you make most of your money in a bear market. You just don't realize it at the time. That's how these corrections work. When it's all said and done, you're going to look back and say, I'm glad I stayed on my plan. That's all I've got for you for before the questions. Sam, I'll let you take it away.
Yeah, if anybody has any additional questions, go ahead and type those in that button below. We've got a couple here for you, Nick, already. And I do, in fact, have the crystal ball if you need me to hold it up for you to look into to answer any of these. It is heavy, though. So, first one is a little bit more company specific. As we look at names like Tesla and Nvidia, where do you see the smart money moving to? Obviously, both of those names have seen pretty significant drops here at the beginning of the year. And what's the impact going to be? We've seen a lot of car manufacturers move away from going all electric. They're voting for more of a hybrid, approach to car manufacturing. So, would be great just to get your insight on those two companies.
Yeah, I think look, Nvidia and Tesla are very different businesses from a valuation standpoint and from an earnings standpoint. So Tesla trades at a much richer PE than Nvidia does. Nvidia now on a go-forward basis trades right around 30 times earnings. Well, guess what? Guess what else trades at 30 times earnings? You've got Costco, even Procter and Gamble now is starting to get pretty close, and even a bunch of companies you never think would have a similar PE to Nvidia do. And the reason for that is Nvidia's got great earnings. They've got great cash flows coming in. They've got great margins. And so I think long run, now this is not stock advice, so I'm not telling you to go out and do anything with this, what I'm about to say, but I think long run, Nvidia is probably slightly undervalued here. Tesla's a little bit different. I think long run, Tesla is going to have to work through some of the valuation issues. It's just trading very richly. But one of the key metrics on Tesla is the fact that they're logging something like 1 million miles a day on their full self-driving technology. The closest competitor is only doing 1 million, but they're doing it in a year. And so Tesla has this massive head start on FSD, on full self-driving. And I do think in our lifetimes, we're going to see that approved. The question is how quickly in our lifetimes. And so you're just going to have to be patient. We've underweighted both of those names. We've underweighted NVIDIA. We've underweighted Tesla. We still have them. We still think they're great companies. But when you have higher octane numbers like that, you just have to be prepared for bigger drawdowns. And that's called beta in the portfolio. So the more beta a stock has, or the more exposure it has to higher PE ratios, you're going to have to deal with more volatility. So a stock like Nvidia could easily correct 50 or 60% in the short term before going back up. And that's what you have to live with. That's part of being in a higher PE stock. Now, what are people buying instead of Nvidia? Why is it selling off a little? Well, people are starting to rotate into healthcare companies. People are rotating into energy companies. People are rotating into more defensive stocks. One of the areas that we've liked for a long time is financials. And so Stenger Family Office has been just slightly overweight on financials. And part of that is because banks benefit from a lot of M2 and more money printing. So you saw M2 go way up. And sure enough, JP Morgan, the strongest bank in the country, went up a bunch too. We were buying it at right in the 90s, and now it's in the 250s. And you know, that's typical during these inflationary environments. So we like financials, we like healthcare, certain parts of healthcare, not all of healthcare, but that's where you're starting to see some of the money go towards. I think energy, you have to be a little bit careful. It's sort of a hedge. However, some of these energy companies are actually trading pretty richly compared to where their earnings are coming in at, which is why you're seeing layoffs. Chevron is doing a bunch of layoffs. Shell has laid off a bunch. BP has laid off some people. So I believe the earnings are a little softer than people think. So, you know, we've been basically neutral on energy here.
Okay, and then one other question, Nick. You brought up Warren Buffett earlier. Berkshire Hathaway, there's a lot of news. Obviously, their cash pile has continued to grow, setting on record highs right now. This is something that we've been paying attention to for like 2 years now. But, you know, do you have any concern there? Typically, Warren has built these cash piles up before stresses. Is there any relevance to a concern with that at the moment?
Not really. And, you know, part of the reason is if you followed Warren Buffett or you followed people that talk about Warren Buffett a lot, you know, they'll say, here's how you invest like Buffett. You know, that's like the common thing, invest like Buffett. Well, you know, the reality is you can't. You aren't Warren Buffett. You don't have, you know, what, 180 or 200 billion dollars in cash on the sidelines. You're not going to go in and buy a whole company like he is. And you know, so to invest like Buffett is kind of a ridiculous statement. You know, it's not going to happen. And so for most of us, if we want to be great stewards of our capital and be long term on a plan, that's what we have to do. We have to ignore these big ups and downs in the market, and we just have to stay on our long-term plan. And I know it's not a perfect answer. Do I think Buffett's preparing for a rainy day? Sure. Maybe there's some tax implications of if he passes away, why he would want to have some cash anyhow. I think there's some of that going on. But you know, the reality is you know, don't focus too much on these big time whale investors that you hear about. Another one's Jamie Dimon. For the past 6 years, Jamie Dimon said that the world's coming to an end. And, you know, basically he's been wrong for 5 out of 6 of those. So I just think you got to be careful who you're listening to for actual trading advice. If you're going to buy Berkshire Hathaway stock, great. You're understanding, which we do, by the way. You understand when you buy Berkshire that you're getting a large part of your earnings now from this interest that he earns on the cash. So great, you know, maybe that's part of your strategy. But and same thing with JP Morgan. You want Jamie Dimon at JP Morgan to be conservative. He's running the biggest bank on earth. He's supposed to be conservative. But for most of us on a plan, we are not Warren Buffett. We're never going to invest like him, and we have to ignore this and just stick with a diversified portfolio over time.
Awesome. Well, no more questions. Really appreciate you taking the time, Nick, and thanks to all of you for joining us. If you're not yet getting the clarity and the confidence on your plan, reach out to us. We make it really easy. We've got a great starter account program. You can literally start with $1,000 with us. Give us a call at 630-912-8431. We would be happy to help you out. So again, we really appreciate you taking the time and hope you have a wonderful rest of the day.